morning and welcome. Patriot Radio News Hour. Joe and Jason, happy hump day. And I guess the day after the red hot inflation report, a big down day in the markets yesterday. Started out like, hey, maybe we're going to have a little bit of a bounce back. We'll see. Right now, things are kind of looking very, very flat in the markets. We're going to get the producer price index. I think it's tomorrow. I thought it was today, but I guess it's going to be tomorrow. Mortgages today. Well, I think everybody knows rates are back up. Mortgages continuing to fall. And these are year-over-year numbers, and we know how bad last year's numbers were. So we'll talk about that. More commercial real estate problems, Jason, and again, more debt problems all over the place, especially worry now from the central bank. And here's what's funny. You know what's so funny is they're worried about how much money the government's spending. But they make no mention about how much money they spend, right? I mean, it really is, kind of the pot calling the kettle black. No, well, it's okay if we create all this money out of thin air. It's just not okay if you do it. And I think, and again, the rest of the world is watching, right? Because at a certain point, okay, well, I mean, does anyone really think we're paying back 34 or 40 or 50, $100 trillion? And again, if you only want to look with right in front of your face, 2024 is going to be your chaos. We know this. I just have this horrible feeling of somehow the guy that doesn't even know what he's talking about with zero cognitive function is going to get reelected. I don't know. We'll see. I don't know that, but that's the feeling I get. And Jason, things like Medicare and Medicaid, because they go broke first. They talk about Social Security. They always want to. Social Security goes broke in 2033 or 2032. They never tell you Medicare and Medicaid actually goes broke first. Which means they're going to divert Social Security money there, which means Social Security is going to go broke even sooner as well. But hey, don't look into the future. Just pretend everything is wonderful. Somehow we're going to get a miracle landing of all of this money. You cannot print the type of money out of thin air that the United States did and not pay a price for it. 800-951 0592. That is our toll-free number. The website at allamericangold.com. And it's to the point now where people are openly debating, Jason, what's going to happen with the dollar, right? How long is the dollar going to be the reserve currency of the world? And it's not like the dollar goes away, right? We're not saying, hey, the dollar, everyone's going to stop using the dollar. It's just a matter of, hey, at 5% less, 10% less, 20% less, and all of a sudden, you cannot continue to finance your debt problems. It's one thing when the dollar was being used for 80 and 90% of the purchases around the world, and the debt was, $5, $6, $7 trillion. It was pretty easy to refinance this stuff. Now it's 34 trillion, and the dollar's down to 59% and falling, and it's starting to create a problem, Jason.
Yeah, it's a problem. It's why the inflation's here. Print it, borrow it. Interest payments. But it is a world situation, Joe. Another currency tends to print a bunch more. Like, let's say England decides to take down a little currency, have austerity. Well, then suddenly the dollar's printing more. It's really interesting as if you look at all the currencies as a whole, since this is their, Brave New World sort of situation, a new world order, as George Bush said. These currencies are growing worldwide. So even though the Fed is tapering, right, Joe? They're taking some off the balance sheet. Well, China's not doing that. China's printing right now, right? These currencies are growing and growing and growing. It's too big. If you look at all of it, it's coming to a head. This is why the Great Reset, you heard this the last few years, it's going to happen. The last worldwide economic reset was World War II. So I don't think we're going to have something that looks like that. It's just going to look differently. We don't live in a digital world. We have economic wars. We have info wars. We have different ways to create emergencies. You have a war against a germ. You have a war against terrorism. You have a war against drugs. So they can concoct whatever emergency they want, and they'll say, well, I'm sorry that you have no money in your bank, but it was the emergency's fault. This is why you got to know how to be ready before the fake reindeer game, so to speak, of these bankers and the corporate interests of the world pull their stunts, Joe.
Yeah, and again, it's just like the Federal Reserve now. All of a sudden, right? All of a sudden, oh my gosh, we're so worried about what Washington's doing, right? But at the same time, what we're doing's okay. Right? I mean, it's just this ridiculous. This is why we talk about it we've talked about it forever and ever. We need to get rid of the central bank. We never needed a central bank. And really, the bigger problem is the amount of money they print and don't tell us about versus, at least with the government, we know how drunken they are with debt. Right? We'll be back right after the break. 800-951-0592. Joe and Jason here on this Wednesday. Quick look in at the market. So the Dow was down 500 plus points yesterday. Right now it's up 20. It beats down. We'll see how it closes. The S&P, which had cracked 5,000, big down day yesterday. Right now up 4,966. The NASDAQ up 48 points right now. The 10-year note down to 428, kind of right back where we were yesterday. It actually closed yesterday at like 432. Crude oil hanging out right just below $78 a barrel. The Japanese yen continues to be above 150. Right now, gold's down 1990, kind of about where we were yesterday. Silver's up 25 cents. So silver really showing some good strength here, bottoming, right? Just not refusing to go below $22. Right now, $22.40. And as we talked about, I think diversification is going to be the key in going forward. And this is going to be the hard part. Going forward, what happens in 2025, 2026, 2027, and beyond? It's just going to be difficult because the game really since 1971, it's been the same. Which is we pretend that, think about what the Fed pretends that they can do. Well, we can control the economy by just moving interest rates up and down. Well, that turned out to be false, didn't it? Right? I mean, think about they had it at zero for 15 years and the economy couldn't get off the ground. Now they've created this inflation problem and want to blame somebody else. But here's the thing. The debt money system that we've really been on for 50 years now, a little over 50 years, has really become a problem, right? In 1971, the debt was $400 billion. Right now, when you add up the money that the Fed, right, we're at $40 trillion, and we're actually over $40 trillion. And now the rest of the world is saying, hey, listen, we like dollars, we do. Let's not lie about it. Right? They don't hate dollars. They just don't love them anymore. Right? We're going to have dollars because, it's the United States, and we need to buy bombs and bullets and planes and, right, we got to buy stuff like that. But you know what? I also can buy crude oil. I also can buy soybean and corn and all of these other things from other countries. And you know what? They charge us less. Right? I just don't need all the dollars I used to need. Which makes it really hard because everybody knows. Let's not kid ourselves. Wall Street is really significantly overvalued. Everybody knows, right? Because it's bubblicious time. And really, 7 to 10 stocks doing most of the lifting, and they're great stocks. Well, listen, Amazon's great. I mean, Jeff Bezos now, we thought he was only going to sell $2 billion. No, he bumped it up. Hey, I'm going to sell $4 billion. Right? I mean, what does that tell you, right? If Bezos say, man, my stock's going to double in the next 10 years, he ain't going to sell $4 billion. And we know, right, the bubble is going to burst. Every time, and listen, it burst in 87, it burst at the tech bubble, it burst at the financial crisis, right? All of these times it burst, what did they do? They went bigger into debt. And that's what's going to be harder this time, because right now they're struggling to finance the debt we've already have, and to print even more of it, right, is going to be, right, very, very difficult. And it's going to cause a thing where, hey, we want rates to be zero, but they can't be zero because no one will buy it. And this is why diversification is going to be the key here. We talk about why refi. We've been talking about why refi for the last couple of years. Listen, 10.25% fixed rates of return, not correlated to the stock market, right? I think that's a really good idea. I do, because I don't see, we're kind of at the end of this boom and bust cycle where, hey, we're going to magically poof, spend $4 or $5 trillion and get the stock market, to newer highs. I just don't see that card being able to be played again until they change the money. So check them out. InvestYRefi.com. That's the word invest, the letter Y, REFY.com. Or just make it easy and call them at 888-YREFI24. And as you guys know, you need to have at least $50,000. But there was a report from the Federal Reserve very concerned over the congressional spending. And here's the funny part. That's out of their control. See, Jason, listen, spending's okay if we can control it, but we're concerned about the spending at the congressional level. They mentioned Social Security. Shh, don't talk about it. Right? Don't talk about it. They mentioned Medicare, as I told you. This dirty little secret that they don't tell you about. Medicare and Medicaid runs out of money first, like 2026. And it's bigger than Social Security. And Medicare, Medicaid, I mean, you're talking like it's approaching $2 trillion. Right? It's like $1.7 trillion. Social Security is like $1.4, $1.5 trillion. Right? Defense, right? Well, it's about $1 trillion. Sooner or later, they'll get that money for Israel and Ukraine somehow. Interest on the debt, right? Well, that's $1 trillion. You see, and of course, they mentioned all of those things. Social Security, Medicare, rising interest on the national debt. And Jason, again, without pointing any fingers at them, right? It's not the bankers. It's not our fault we printed all this money out of thin air. It's Congress's fault.
Well, it's I don't always blame the government when it comes to the financial issues, because they're placed there through their owners. But they do have the power to stop this stuff, don't they, Joe? They can vote America back into the right path if they so wish to, but they don't serve the citizens. So you've nailed it on the story. They're going to do what they're told to do. And the Fed and the financial partners, the corporate interests of the world, they tell the Congress, the Senate, and the President what to do. It's not the voters.
And people don't realize, up until like the early part of the 70s, the debt to GDP, especially after World War II, right? Obviously, World War II, okay, well, debt to GDP really spiked. We've actually passed that level, right? It was about, 25% of GDP in 1975. Right now, let's face it, right? We're way past 100% of GDP. We're way past 125% GDP, right? They're talking about a 30-year increase in the debt to GDP, and they're saying, hey, from 2024 to 2054, and these are CBO projections, so these are garbage, right? These are way under, right? They're already saying, hey, it's going to be 172% of GDP. And I can tell you right now, Jason, the way we're going, this number will be, like 200%. Like GDP will get to 40 trillion. But the debt's going to be like 100 trillion. I mean, this is what is happening. And it's funny that the central bank now is saying how concerned they are with what Congress is doing. Could you imagine? Do you know what the economy would look like if our deficit was only $1 trillion this year? Right? People don't want to talk about it. But here's the realities. We would be in a major recession. Because that's really what the economy is right now, right? Which is we're surviving on deficit spending. We've got GDP growth, Jason, because of what the Fed and Congress are doing. And it's funny now that the Federal Reserve we're so concerned about Congress, but we're not concerned about us.
They're never concerned about us, are they, Joe? They can't afford to. Their re-election is coming around the bend, and they need to campaign for re-election. So you can't get a public servant in Washington, D.C. to be concerned about us. So it's spend, spend, spend. It's deficit growing. It's the U.S. debt growing. And it's the Fed commanding the ways of the interest rates and the money printing. And 3% of the new way of calculating inflation may be the norm from now on, Joe. Can you imagine if we just have 3%, just 3.5% from now on? It just
what would people do?
Here
That's a great question.
It's going to be the norm.
What would people do? Would you notice? Right. So remember that they told us, Janet Yellen, Ben Bernanke, we've got a 2% inflation target. Right? Jay Powell says, we want to get down to that 2%, but they really don't. If it magically happens, right, they're not raising rates, right? And look at what inflation did yesterday. If it magically happens, they'll be happy. But here's the reality. At 2%, every 10 years, you lost 20% of your purchasing power. At 3%, right? Well, that's 30%. At 4%, by the way, the super core number, 40% of your wealth every 10 years. In other words, what they're saying is, hey, what $60,000 would buy today in 10 years, right? You're going to need $100,000, right? You're going to need $110,000. And you got to remember, that's the way they count it. So if it's 3%, it's really 6%. And I think this is exactly what's going to happen with this economy is as every month clicks by, And I don't know what the number is. Is it 100,000? Is it 500,000? Is it 1,000,000? More households run out of rope? Right? Well, gosh, my work chopped 3 hours a week off of my schedule. Or I ran out of rope on my credit card. I maxed out my home equity line of credit. Or I ran out of 401k money to borrow against, right? I mean, this is the slow moving crash, Jason, that's happening right now, on top of the fact that we've got record deficit spending and interest rates not cooperating, right? It's just that simple. Patriot Radio News Hour. We'll be back after the break. $800-951-0592. Patriot Radio News Hour. Joe and Jason here on this Wednesday. Looks like gold may be trying to go higher here, down a dollar right now, 19.91 in change. Silver going even higher now, up 33 cents, 22.50. Yesterday we were running all those date sets and pre-1930, pre-1900 liberties and 1904 liberties, saints. We have some of these things left. Here's what we're going to do. We're going to, anybody that wants to buy $20 gold today, y'all going to pay the same price, $21, $25, whether you buy one coin or buy what we have left, whatever you want, take advantage. So something, and Jason will back me up on this. We got a price sheet late yesterday afternoon, and I thought, okay, they're going to lower the price. Remember, I was telling you guys they're not lowering the price. Gold's down $40. They've lowered it $10. Prices went up $15. Gold today is more expensive today than it was on Friday. And, of course, gold's been down every day since then. And it just tells you the demand. It's really simple here. When I'm out of these 20s and I've got to go to the wholesaler to get more, we're going to be 20 over, right? It should be $2,215. I don't want to charge $2,215. Buy them for $21.25. This is an absolute steal of a deal. It's hard to explain, right, Jason? Because the guy does say, well, gold broke 2,000. Right? What if it goes lower? I don't know. It could. My guess is it goes lower. The premium is just going to go higher, right? I mean, this is just what it is we're looking at. Here's the good thing, though. Gold actually held a good resistance. That same resistance point last time. Silver, same thing. Silver held 22. Gold held the 1980 level, and now, Jason, we'll see where it is. We don't know. Listen, I don't know what gold's going to do. Just like I didn't know what the inflation report was going to be yesterday. But this is a unique opportunity. If you have the means, and I know everyone, I'm waiting for this or I'm waiting for that. Premiums are what they are. Take advantage of buying this close to spot at 800-951-0592, $20 gold pieces, any amount, $2,125. And I still, you know what? I still have that one roll of 1904s. If you want that one, $2,100 at 800-951-0592. And Jason, it is. The physical markets are interesting, aren't they? They care about spot. They do. But only to a point, right? When the wholesalers go out there to buy this product, and the guys that have it are saying, I'm not selling it to you for that. But I need them, right? I need those 20s. Well, okay, if you need them, this is what you need to pay. That's what's happening in the physical market right now.
That's right, Joe. That's right. And as we've said before, there's with these economic things getting tighter and tighter, as you report every day, Joe. There's a lot of people selling. There's a lot of people with so many emergencies, problems selling. And these big distributors that we use and these big companies that sell gold and silver, they're buying just like we are. And at some point, they're going to say, look, we know gold's worth more. This is physical market. We are not going to, this is exactly what's happened this week. They're not going to sell for a lower price. They've been buying and they're taking care of their customers. We're taking care of our customers. And they're saying, look, this is the price of gold. All the funny business going on in Washington, D.C., that doesn't affect the physical market at certain points, at certain situations, Joe. So I find it interesting, the price going up, in a time where gold's going down. It sounds and feels a lot like a couple of years when COVID came in and suddenly the prices would drop after they went up and then the premiums would just take over. Here we are again, right? What emergency is getting ready to happen this time, right, Joe? Because that's what it feels like.
And it really it does feel like that. The Martins, Wall Street on Parade. I just think they do some of the best research out there. And they were talking about these derivatives markets again. I feel like I'm reliving the financial crisis. We're starting to talk about collateralized debt obligations, and we're talking about derivatives again. And you got to remember with the banks, they pass this phony baloney on to people that said, hey, real estate, well, see, that's regional. What happens in New York has no bearing on what happens in California. And what happens in Tokyo has no bearing on what happens in Shanghai, and et cetera, and et cetera, and et cetera. So they said, hey, if we just tear up all of these loans and we take 1,000, 10,000 little pieces, so you got a little bit of commercial or residential, some type of mortgage-backed security. I don't care what it is. You got a smattering in New York and a smattering in Iowa and a smattering in Texas and California and Nevada and Arizona. Maybe we even got some Shanghai, some Tokyo, some Paris, some London. It's all just mixed together. See, that makes them safer. That's what they said. Here's what we found out. The world's become a really small place, hasn't it? And what we're finding out right now is, guess what? Real estate sucks everywhere. It just does. Some places a lot worse. It could be worse here, right? Shanghai's residential market is much worse than ours, but it's not like ours is any good. Well, guess what?
Oh, Joe, it's not. It's not.
Right? The 5 big banks, too big to fail. They now hold $223 trillion in derivatives. That's 83% of all the derivatives of all that are sitting in all of the banks. So, you think about, I don't know how many banks, 4,000 banks, whatever there is. They hold, it's just like the wealth in America, right? The top 1%, they own like 85% of the wealth. If you do the top 10%, right? Well, okay, now all of a sudden you've got 90% of all the wealth in the world in that category. The 5 biggest Wall Street banks hold almost all the derivatives, totaling over $223 trillion. What happens when these derivatives have to be sold? That's really the same problem we had the last time, isn't it? Patriot Radio News Hour. We'll be back after the break. (800-951-0592) Patriot Radio News Hour. Joe and Jason. The deal of the century, $20 gold pieces. It just may be the deal of the century. $2,125, any amount at 800-951-0592. And we can do that for about 75 20s, and then at that point, prices go way up. 800-951-0592. So here we sit again. Here they admit to a commercial real estate crisis. And unfortunately, 2024, it's bigger than 2023. More loans coming due. March, we keep talking about March. The bailout facility for the banks has not gone down. It stopped going up because the Fed won't give you free money anymore. The banks, not us. The banks were getting free money. Think about that. Hey, you've got a problem. Come give us your crap that's actually not worth the money it's printed on. And not only will we give you full price for it, we'll actually give you a bonus. So they stopped that. It should go down because of that, right? So some banks were borrowing that didn't have to, but they just wanted free money, right? What bank passes up free money? It didn't go down. And, of course, the discount window, that's the naughty window, right? The naughty window means, and they don't tell us that. Why wouldn't they want to tell us? Because they don't want you to know. That keeps going up. We talked about credit cards. 50% increase in delinquencies in 1 year. Those are part of the derivatives. Auto loans are part of it. But mortgages are the biggest. And not just residential, commercial, anything with a mortgage. And they have these derivatives. Let me give you an example. J.P. Morgan Chase, the biggest bank in the United States, has over $2 trillion of assets. $2,079 billion. You know, they've got $81 trillion. $81 trillion in derivatives. I mean, a 10% hit would be over $8 trillion. They've only got $2 trillion in assets, right? A 1% hit would wipe out almost half of all of their assets. Basically, they would be insolvent, right, with a 1% hit. Bank of America. They've got $2 trillion in assets. Almost $78 trillion of derivatives. Goldman Sachs, they don't even have $1 trillion in assets. $47 trillion in derivatives. Morgan Stanley, they've only got $600 billion in assets. $39 trillion in derivatives. And then I guess the best of the group, Citigroup, with $1.8 trillion worth of assets. But don't worry, they've only got like $32 trillion in derivatives, Jason. So I'm sure there's not going to be any problem here at all. I mean, what could be wrong with that picture? What could possibly go wrong?
Okay. The more you talk about the way they do things, the more sick it makes me. It's just, I know it's how it works, but it's like nobody's got a brain in their head and nobody's courageous enough to stand up and just question it. What did the Rothschilds, the Rockefellers, they said the system that they're setting up, the system we set up will be so lucrative to investors that they won't want to talk about it, or people won't have any ability to fight against it. Those that have the ability will be too interested in its favors in the system, and those that are against it will have no voice, right? Yep. See, so it's that's why I say many times, you got to take care of your little corner of the world first. It's always great to be a warrior for justice and truth and the American way, so to speak. But you can't fight a war if you can't take care of your own finances. That's just the way it is. They've dominated the citizens of the world through debt. Joe, derivatives, that's a debt tool. Everything the Fed does is a debt tool. Everything's about getting you in debt, because even in the Bible it says, if you want to be a slave, be in debt. So here we are, Joe. Try to get out of debt. Try not to put the burden of interest on your shoulders, because I'll tell you right now, a lot of you guys out there who are paying mortgage interest, credit card interest, school loan interest, and all that stuff. If you can get rid of those interest payments, man, how many more ounces of gold could you buy? Ounces of silver could you buy? It's a very freeing feeling when you pay off that debt and you can put it towards something that helps the value of your financial goals get a little heavier, right? How heavy is your wallet, so to speak, Joe?
Yeah. How much does your IRA and 401k, how much do they weigh, right? That's an important thing. And when we're sitting there and, you're talking about all of the debt instruments and whatnot, I just find it interesting that the Federal Reserve comes out and starts talking about, oh my gosh, we're so worried about what the government's been doing, but pay no attention to what we've done, right? Pay no attention to the banking system that we brought up, and people think that Wall Street at 38,000 has somehow saved them. That's the beauty of it all, right? The middle class keeps getting more and more decimated. The vast majority of people now can't afford a home. Hell, the vast majority of people now can't afford the average new car, and yet they think it's great. Patriot Radio News Hour, final segment coming up. (800-951-0592). Joe and Jason, Patriot Radio News Hour. Don't worry. I'm sure that it's going to be fine. What could possibly go wrong with all the derivatives, and what could possibly go wrong with all the spending that's been occurring, and I mean all the warning signs, right? The fact that for the first time, really, in probably most of our lifetime, the government now, these debt auctions, right? They're not a sure thing. Nobody really knows what's going to happen, right? I mean, it's not like, hey, we're not going to sell it, at least right now. We'll sell it. But nobody knows what the price is going to be, right? Nobody knows, well, who's going to show up, right? How much of the debt is going to be having to be absorbed by dealers? Is the Fed going to have to start quantitative easing all over again? And we know quantitative tightening, Jason, is getting ready to come to an end. And don't worry about these derivatives. I know that the derivatives, it was bad the last time, but this time, I mean, I know we made it worse, and it's actually bigger, and they've got more derivatives now, but this time will be different. It'll be different.
Different meaning bigger and worse? How's that sound? Bigger and worse? I remember Silicon Valley Bank going under last year, and then finding out that by dollar size, it was the biggest bank that went under. I was like, well, what about Lehman? And that's how big the smaller banks have gotten. That's how congested it's gotten. That's how bloated it's gotten. So when you say derivatives are failing, it's different. Well, yeah, it's different. It's bigger and worse. Bigger and worse, Joe. I mean, how many of these things grew after the '08 crash? They just kind of coasted for a while, tried to fix themselves, and then they just pumped that balloon back up. It's that's why I don't like getting involved in stuff like that. There is ways to make money if you're one of those guys that can read the tea leaves, so to speak, in the markets, and you can buy and sell at the perfect time. But I've seen stuff about crypto trading and stock market trading, and like 5% or is about the level of people that can actually day trade and make money. It's there's just not a lot of room there to make money. You have to be really good at what you do. Just the fees and the taxes and things will just kill you whatever little bit you make, right, Joe? It's rigged. They got it. It's best just to figure another way around it, Joe.
Yeah, that's exactly it. Be diversified here. Just a fantastic opportunity on $20 gold pieces here at 21.25. Gold's 19.92, down a dollar. It's been kind of just hanging here, looking like it's trying to go higher this morning. Silver's up 30 cents. Quick look at the Dow right now, up about 40 points right now on the Dow. Actually, take that back, down 11. So after yesterday's big drop, so far anyway, and it's early, right? A lot of fireworks can happen. But again, Jason, how much room is really left here as we watch, all these currencies struggling? The Japanese currency, the euro, the yen, the dollar, the renminbi. 800-951-0592. Jason and I were coming right back with the half-empty cup. You're not going to want to miss